Chapter 5 covers a topic that's often difficult for many students to understand, and that's the topic of closing entries. So in this video, we're going to take some time looking at why we do closing entries and how we do them. So in front of us, we have a worksheet. We could also have a trial balance in front of us to use for this. And we have the 2 months ending December 31st, 2000, let's say 2001, and we've prepared the financial statements. We're done with the accounting period and we're ready to move into the next accounting period, so into the following year. And what we run into is that although some accounts we want the balances to carry over, such as cash, accounts receivable, we want the ending balances to become the beginning balance for next year. There are quite a few accounts that we want to start new. So if you look at the accounts highlighted in blue, these are what we refer to as temporary accounts. They include drawing, revenue, and all our expense accounts. We want those to be zeroed out in the books so that we can start fresh, keeping track of our revenue and our expenses in our drawing for the next period. We often refer to these as the red accounts: revenue, expenses, and drawing. So let's go to the last page of our handout and take a look at the journal entries that we would have to do to accomplish this. What we do is we do four different journal entries. One closing out revenue, and we can see the R for revenue, E for expenses. We'll do a final journal entry to close revenue and expenses into capital, and then we'll close out drawings. So just remember, for the closing process, you need four sets of journal entries. The first one, we're going to take revenue. Revenue was sitting in our accounts as a credit, so we will need to do a debit to close it out, and we're going to drop that balance into a very temporary account called income summary. It's just to close out revenue and expenses. The next step that we'll take is to close out the expenses. All our expenses are sitting on the books as debits, so to close them out, we will do a series of credits to each account, and then the total of that balance will drop into income summary. The third step is taking the net balance in income summary, which is $4,700 credit minus a $2,255 debit from revenue and expenses. That is what's sitting in our income summary account. We want to close that balance out, the $2,445. Close that out to capital. That will be the final resting place for our temporary accounts. And the final step is to close our drawing account, which is a debit balance, and we want to close that to capital. Now to take a look at what this looks like in our T accounts, let's go up to the middle page of our handout. And we can see what the original balance was in the account. You'll see balance next to each account, and then the closing entry that was done to that account and where those numbers went. So looking at the revenue revenue account, we can see that there was a balance of $4,700 credit in there. We took that out with a debit to revenue, and we brought that over to income summary. So just take a couple minutes looking through this series, and you'll see what the natural flow is for the closing entries. The acronyms really help. You want to close all the red accounts: revenue, expenses, and drawings. And how you do that is through the process of READ. Close your revenue, close your expenses to income summary, then close your income summary to your capital account, and then finally closing your drawing account.